Hello everyone, and welcome to the third quarter BlueKey market review and outlook. And today's webinar is titled, "We'll Start the War from Right Here." And I was reminded of that quote last week when our president went ahead and made the conscious decision to lay down the first wave of tariffs against China and made the trade war official. The quote is taken from Teddy Roosevelt Jr., who was the only U.S. general to land on the beaches of France on D-Day in June of 1944. Roosevelt was in the first wave and landed at Utah Beach, way south of their projected target. But when he got off the landing craft, he looked around, realized he was in the wrong spot, and then impromptu said, "We'll start the war from right here." Of course, World War II was a noble war that had to be fought. The economic trade war that Trump has chosen to start pales in comparison, and we don't mean to compare the two in terms of importance. But the point is that the U.S. has made a decision to start this, quote, war, and it's an economic war of our choosing, and time will tell what the ultimate outcome will be. So let's take a look at the market for the first half of the year, and the S&P 500 was up by 2.59%. That includes dividends, and without dividends, it's up by 1.67%. And you can see that on the white line right over here, cutting from December 29th through June 29th. There were basically three waves in the first half of the year. The first blue wave, we had a sharp rally up 7.4%. That ran through January 26th. Then we had the first correction in a long time. The market was down just over 10%, and that would be the yellow line here. And since then, we rallied. So to close out the quarter, we were up 5.29%. Again, for the entire quarter, plus 2.59%, including dividends. And through July 17th, the market has rallied since then. Here's the first quarter off to the right, and you'll see there was a decent amount of red and some green on the growth side. In the second quarter, everything was up, especially on the growth side and then also small cap. So if you were in small cap growth, you were at plus 7.35%. And then for the first half of the year, growth again is the big winner. Looking at sectors all the way off to the right over here, you'll see that biotech was tops with 12.4% advance for the first half of the year, and consumer staples was down 8.23%. Financials were also down for the first half, as well as industrials. Industrials impacted a lot by trade war talk. Internationally, everything was down. So if you were diversified across international and U.S. stocks, while U.S. stocks were mainly up, international stocks were pretty much down. Emerging markets down 7% and frontier markets down 11%. In the fixed income markets, it was pretty much the same. If you owned emerging market debt, you were down. So here's USD emerging market debt down 5.39%. High yield emerging markets down 5.7%. And if it was denominated in local currencies, minus 7.6%. If you remember from past webinars, emerging market debt had really been on top for a while, so it was due for a reversal. Most fixed income was down for the first half of the year, unless you were on the shorter end of the curve where you scratched out some increases. Let's see where the economy is headed, and this is the Conference Board's leading economic index. And the blue line is the leading economic index. The red line is the coincident economic index. And you'll see that the blue line, which is basically looking forward 6 months, has been increasing faster than the coincident economic index. And that is considered a good sign and would generally point to future growth. If you look over here to the right, you'll see, though, the last couple of months, the pace of the increase of the LEI over the CEI is slowing down and hasn't been as much as in previous months. So when the LEI starts increasing less than the CEI, as you can see over here, let's say in 2004, 2005, you began to see the turn, that normally is a hint that somewhere in the future you're headed towards recession. But for now, at least, this projection looks very positive. Here's the Treasury yield curve, and investors are always worried about a flattening curve because that has often been a signal of a future recession, usually on average, about 20 months down the road. So the blue line is from last year, that's July 10th of 2017. The green line is from this year, about a year later. And you'll see at the long end of the curve, we're pretty much where we were a year ago. That's on the 30-year bond. And on the 10-year bond, it's a little bit higher. But look at the big increase on the short end. So because of that, the difference between the 10-year and the 2-year bond has narrowed a lot. So as of June 30th, the difference between the 10-year and the 2-year was 0.33 or 33 basis points. And since then, it's declined even more. Now it's about like at 25 basis points, I think, today. So investors are worried that if the curve inverts, that often is a sign of a recession somewhere down the road. This chart here from the New York Fed compares the 10-year bond against the 3-month T-bill, and you'll see that when it goes to less than zero, often there is a recession somewhere in the near future. So we're not there yet, but we're getting close to there. The New York Fed calculates the probability of a U.S. recession 12 months ahead, and for June of 2019, it's projecting 12.51%. You'll see that how that has been increasing over the last several quarters. This is the 4-week moving average of initial claims for unemployment. You'll see the labor market just continues to really perform, and the 4-week average has been continuing to decline. Generally, when it starts turning up, there's a recession somewhere down the road. But we don't see that as of now. This is weekly hours worked. Same idea. This is the percentage change year over year. And for now, it's generally been going up. It has dipped down just a little bit in the last month or so. But for the most part, this looks strong as of now. Lightweight vehicle sales, these are basically auto sales and light trucks. It has gone down a little bit, so maybe we're seeing the beginning of a possible decline in the economy. We'll have to see, if this turns up from here. There have been other periods where it does decline and then it continues to advance. See back here, though, when it does decline, sometimes we have a recession at a future point. This is the Institute of Supply Management's Purchasing Managers Index, and the June PMI went up to 60.2 from 58.7 in May. That is a very strong number. Anything higher than 50 is considered expansionary. So right now, this continues to go up, not down as it often does before recessions. This is the Purchasing Managers Index, and this is a global look. So the composite index is at 54.2, manufacturing's at 53, non-manufacturing of the services at 54.6. So this did go down for a little bit, but it turned up in June, except manufacturing did slide down. Overall, it's still north of 50, and north of 50 is considered expansionary. So growth seems to be slowing around the world, but we're still in an expansionary mode. Here's a look at projected GDP growth for the second quarter. The graph on the left is from the Atlanta Fed, and they're projecting 3.8%. That would be very strong growth. The New York Fed, a little lower at 2.79%. Down here off to the right, you'll see growth by quarter. So if we get in, a plus 3% area, if you take the average of these two and we're plus over 3%, that would be considered a very solid quarter. Of course, we basically expanded the federal deficit by billions and billions and billions, which is helping propel the economy at this time. But the bottom line for right now is Q2 should be really strong, and we'll see if it can continue after that. This is the IMF projections for the World Economic Outlook. This just came out yesterday. You'll see the advanced economies, they're looking for growth of 2.4% this year, 2.2% next year. Overall, the global economy, almost 4% this year. And the emerging markets is where most of the growth is, right at about 5%, which is kind of interesting because the emerging market equities have been the sector that was hit the most, but they have the most growth projected ahead, at least according to the IMF. This is the Centex survey, which looks at investors' perceptions of the economy around the world, and almost everything is in a slowdown or downturn mode. And if you looked at this survey as recently probably as 6 months ago, everything was looking up. Now things are starting to look down. This chart here shows inflation for different products since 1997, and these items down here are things that are generally imported items. And when you see, for instance, like television sets, prices have declined, as everybody knows. And a lot of that is because of free markets around the world and free trade around the world and our ability to import products from overseas. So this has been a headwind for inflation. In other words, this has kept inflation down over the last 20 years, all these products down here. But now, if we're entering a trade war with all these tariffs and with consumers not able to buy products from the most efficient producers, well, all of a sudden, this headwind is going to become a tailwind at the back of inflation, which could push inflation higher. And here's an example. There were some tariffs placed on washing machines several months ago, and now washing machines are up in price like 18% over the last few months. You know, this is what the problem is with a trade war. You end up with higher prices, faster inflation, less efficiency, slower economic growth, a higher threat of inflation. So all of that is not good, and a lot of the expense of all these tariffs and a trade war is not felt now, it's felt down the road. And it's basically going to cut into global growth and U.S. growth unless we can pull back and open up markets and promote free trade. And that's really the approach that Trump should be pushing. But this administration really has not come out and said what their objectives are. I don't really believe they want free trade. Here's a list of market risks. We publish this every quarter, and at the top we now have tariffs and trade war, and I think that was there last time also. We showed this chart last time. This is a long-term problem. While our federal debt should be going down at this point in the economic cycle, it's been going up because of the recent tax cuts, and it's just going to continue to rise and to rise and to rise, and at some point it's going to come back and hurt us. So this is a long-term threat. Here's a look at future interest rate increases, and you'll see here the blue line. This is the Federal Open Market Committee's projected interest rates going forward, but the market is taking a less aggressive view. They don't think the Fed is going to follow through. There's a mismatch between what the market thinks and what the Fed thinks, and if indeed the market eventually catches up with the Fed, well, that might be a negative both for the bond market and the equity markets. Here's the 10-year yield, and it's at 2.83%. That's as of July 13th. Pulled back a little bit from a few weeks ago when it broke over the 3% mark. This chart looks at sell-offs since 2005, and we already had one sell-off this year, January 26th to April 2nd. We were down 10%, and that was really the first correction in a long time. Over here on the left, you'll see sell-offs when we had more than 3 sell-offs in a particular year. So we had that happen in 2007, 8, 9, 10, and 11, and then you'll see the last few years, 15, 16, and 17, and so far this year we only had one, and in 17 we didn't have any. So far we've had one. It wouldn't be unusual for there to be another sell-off or correction this year. Let's start looking at here's a look at forward PE ratios for the different S&P indexes, and the red line is the S&P 500. You'll see it's a little bit higher than 16. Over here it's 16.3, and if you draw a black line from where it is straight across dating back to 1999, you'll see we're pretty much in a range of like fair value. There have been plenty of times where it's been much higher, many times where it's been much lower. So based on forward-looking earnings, and assuming that these forward-looking earnings don't decline in the future, the market really is not overly valued looking at this particular metric. And this is why they're projecting big earning increases for this year, and so far those earnings increases have come through. 161.20 for this year, another big increase next next year of about 10%, and then in 2020, again, about 9%. We look at earnings projections each week for 2018, 19, and 20, and really they have been continuing to go up almost every week since March 31st. So earnings continue to be the strong point that is really driving this market, and so far, analysts are not too worried, it seems, about trade war. Here's the Moody's BAA bond yield less the S&P 500 trailing GAAP earnings yield, and as this number gets bigger, that would mean that bonds are more attractive. And so far, for this metric work, we continue to be at close to very low levels of about 30 basis points. So this would be a reason why stocks still represent a good value. In this chart here, we're looking at the 10-year Treasury yield, and as we showed you earlier, that has gone up a lot over the last year and a half or so. And we're comparing it to the Dow Jones total market dividend yield. So now the difference is almost 1%. So based on this particular metric, bonds are definitely giving more competition to stocks for every investment dollar. This is the Morningstar median stock, measuring the fair value, and it's just under fair value at 99% of fair value. Again, so based on this, equity markets are not wildly overvalued. They're kind of in a range of fair value. This is Value Line's projection going forward 3 to 5 years. They're projecting 40% appreciation during that time period. Last time we looked at this last quarter, it was at 45%, so it's declined a little bit. So reasons why the market might go up or why might it go down. On the positive side, you have really solid earnings increases this year and continued projected strong increases in 2019 and 2020. And when you take a look at PE ratios on a forward-looking basis, they're really in the reasonable category. So if interest rates and inflation could stay under control, if the trade wars cease and we could get back more to a free trade agenda, those are the reasons why the rally can continue. Reasons, though, why it might go down, first and foremost, we think, are the threat of trade wars. This is going to be a self-inflicted wound if it continues, and because of that, we think there's a heightened risk in the market right now that we didn't have before. Couple that with Fed rate hikes, the continuing unwinding of the Fed balance sheet, risk of higher inflation, exploding U.S. deficits. All these things could put pressure on the PE ratios, which could cause the market to decline in some manner. You also have the risk of the November elections coming up and just a general everyday mayhem in the Trump White House. So we think overall there's just a heightened sense of risk right now in the market. It's always important to think long-term in investing as well as pretty much everything else. So consult your advisor, determine what your time horizon is and what your risk tolerance is. And remember, the long game, you see it here, that over time, equities traditionally have paid off, although there are always periods when markets do go down or they go sideways for a long time. But over the long run, equities have been a good place to be. Thank you very much for joining us today. If you have any comments or questions, please contact us, and you could read our weekly newsletter, available usually every Sunday or Monday at BlueKey, pwp.com. Thanks very much.